So thank you for joining us this afternoon for our quarterly hot topics update. At the end of the session, we'll provide you with the date of the next webinar that we're going to host, but these are going to be a series of webinars hosted throughout the year that hopefully give some insight, some food for thought as people take away and think about some of the challenges that maybe we're facing in the sector. We all hope that 2022 would be a smoother year, perhaps one that there were a lot less challenges facing the sector and our clients in particular. Unfortunately, that isn't turning out to be the case. So what we're hoping to do today is perhaps touch on some of those things that are being discussed around board tables with management teams and think about perhaps a few things that might help some of those discussions. But to start today's session, I'm going to pass over to Sophie, who's going to take us through our high street sales tracker to give us an insight into what's actually happening out there with the consumers at the moment.
Hello and welcome. Can we have the next slide, please? So I just want to take up a few minutes, just take you through the trends that we're seeing in our high street sales tracker. And for those that don't know, our high street sales tracker looks at discretionary spend, both on a store channel basis and also online and a total tracker. It therefore doesn't get distorted by food and fuel, but it tracks across fashion, lifestyle and homeware. It's incredibly difficult to interpret some of these results, and we all know that's due to the volatility that we've seen over these past 2 years. It's as a result because of at times we've had certain channels being stores completely shut and therefore the only channel open being online, but also the impacts that these big events have had on consumer social activities and their buying behaviours. Hence, it's also really important to corroborate some of these trends with information and insights, and other information that we can find. And our tracker also goes back for now almost 15 years, which gives us that insight. What is clear is that consumer spend has been strong throughout 2021 and up to date, despite the challenges of COVID and despite all the noise and big news stories. Retailers have really shown a remarkable resilience, and consumer spending has continued to remain strong. On the left, you can see the tracker for the past 3 months. The red line is total spend and the blue line is non-store. Pre-COVID, you would see total spend moving between, say, -2% and +3%, and very rarely did it go outside that range. And similarly on the online, you would have seen the online moving at positive up to about 20%. During COVID, we saw that rocketing to about over 100%, but you can see why this is so difficult to interpret. It's interesting, on the right side, you can see the results for the past few weeks in April. And in the past 2 weeks, last week just gone isn't on here, we've seen total spend fall. And this is what we've been indicating for some time now, that this cost of living crisis, the increasing inflation, it hadn't really hit and started eating into spending until we're seeing it just now. There's significant headwinds ahead, which therefore haven't really yet taken hold of that consumer purse. Next slide, please. When we look at it by subsector, homeware's dipped for the first time this year after recording the most consistent run of positive results out of all the categories throughout the pandemic. And having suffered significant declines during the lockdown months, lifestyle and fashion have very much led the way. But what is clear is, as I said, they followed very similar patterns and they have remained strong. Next slide, please. What this shows is that the non-store like-for-likes, the brown line, as you would expect, reveals an inverse relationship with footfall. This is, as you would expect, and as a footfall rebounded in November 2021 and in the year to date, non-store like-for-likes declined from record levels set during lockdown. We regularly, as I said, saw non-store over 100%. And in fact, we've this year in 2022, we've just began to see it fall into negative. But those drops aren't that big compared to the big increases that we saw, which shows that that permanent shift to online is very much here to stay. And it's not just the consumer getting used to buying online, but it's actually businesses throughout the pandemic have really revamped their online offering and built that consumer trust in shopping on that channel. So it's a good set of results in the first few months, but we are beginning to see those headwinds beginning to bite, and we're beginning to see it slow down. And I think for the past 2 weeks, we're seeing consumer spending at below pre-COVID levels. It's difficult to completely conclude on that, but given where the results are coming out, we are beginning to see that drop. Consumer confidence is one of the main drivers for discretionary spend, and the latest results in April show significant negative drops which is taking it back to 2008 and even the initial COVID shock in 2020. So all of that sounds quite negative, but we all know that what's going to be absolutely key is managing cash and spend and making sure that investment is made in the right areas. And much of this presentation is around ESG. So despite the challenge on costs, there's going to be still that focus on ESG is going to continue to be important in the consumer and investor mind. And it's going to be really important that the retailers remain flexible to the headwinds ahead. I'm going to pass back to Laura.
Thanks, Sophie. If we can move on to the next slide. So what we wanted to do in today's session is to start just giving that landscape to what we're seeing from the consumers, what's affecting revenue across all of the businesses within our sector. But as we move through today's session, we then want to think about, okay, but there is revenue challenges, there's also cost challenges. And in our conversations that we're having with all of the businesses across all of the people that you'll meet today, it's around the challenge of some of these inflated costs that are really going to affect both short-term but perhaps medium-term profitability in the sector. One of the areas that we do see that could potentially mitigate some of those challenges to profit, as Sophie said, is ESG. ESG is something that we've been talking about with clients and businesses for a number of years, and the temperature gauge around how much of it will become hygiene versus how much of it just has to become normal ordinary course has been something that has been a continual debate, but it definitely continues to be on the horizon. And what we wanted to do today is to take you through the landscape as we see it, because unless you are thinking about ESG, it's something that you could catch a cold on in the medium term as we get through the next 12 months and some of the short-term challenges. And this ESG agenda continues to be something that for the sector is going to have a serious impact. So we've moved on to the next slide, and I'd like to invite Tom and Zoe to join me. And again, if we just move forward. So Zoe, can you help us understand what is the ESG landscape? It's a word that everyone hears, listens to, but what is it truly, and how do we see it, and how do we see it affecting our sector?
Yeah, thank you. So it is very much 3 letters that get used quite a lot at the moment, but 3 letters that cover a very broad spectrum. So the climate change aspect is very much constantly in the news. There's a lot of focus, a lot of attention, but the ESG agenda is not just about the environmental aspects. It's not just about reducing your climate change emissions. What you can see here on this slide is that it pretty much covers across all of the different areas of a business. It's really, I guess, thinking about how you're responding to climate change, but then how you're also treating your workers, how you are building trust, fostering innovation, and also managing your supply chain. So something that is very far-reaching and not necessarily something that you can just designate to one individual to manage. it's also something that there's not an easy one-size-fits-all approach to. In terms of ESG and what it means for a business, it will very much be dependent on your business's purpose, your business model, kind of your brand, what you're trying to achieve, but also the different importance of different stakeholders. So whether it's employees, consumers, lenders, investors, they'll all have different focuses on different elements of the ESG agenda. So it's really understanding what is important to your business, how can you manage risks and opportunities, but also then use those as an opportunity to build success across the short, medium and longer term.
And so we can see the landscape there, Zoe, but as we look into the retail sector, Tom, what areas do you think that some of our clients, businesses in the retail sector, are really having to, but also wanting to focus on within this landscape?
Well, firstly, I think when you see a chart like this, it really brings home the depth we are actually talking about when it relates to ESG. And in particular, I think we're seeing a lot of focus in retail and hospitality, certainly around the social and the climate change, so the E and the S really. And we can see that people are starting to use it as not only a commercial benefit, but also a differentiation against their peers. And if you take some examples in different areas, so in human capital, the kind of talent attraction in this sector is hugely important. And the benefits that people would have probably typically looked for in 2019 are starting to be heavily scrutinized. And we've obviously been through a period where people's well-being has been much more promoted and put in quite rightly into the forefront. Diversity and inclusion is a significant area of focus for many businesses. So we are seeing a different approach to how people are going about rewarding and providing differentiated employee experiences. And those in turn, given the high staff cost base that are usually evident in a retailer, is something that I think is a focus. And on the other side, in the environmental area, you have got people really starting to look at their ongoing cost and impact in society as it relates to their carbon footprint, or just in terms of the goods. Retail, especially apparel, gets a very bad reputation in terms of the amount of goods that are sold or produced globally. And so you're really starting to see people take into consideration how they can use their big audience to try and change behaviors. And the most recent example of interest has been the collaboration with Marks and Spencer's and High Street, trying to really promote the circular economy. So I think that mainly in the S and the E, we're starting to see retailers really focus.
And some of those points, Tom, clearly people are looking at how they change their business to be a better business under this title. But Zoe, how much of this is just going to become regulation, and therefore people listening into us today actually in probably not too short an order are going to have to do this rather than doing it because they choose to?
I think a lot of it is probably the short answer. So I think, unfortunately, to drive, I guess, development in this area, we are seeing increasing regulation. So if you look back over recent years, there's already been kind of specific ESG focused regulations. So there's those around carbon emissions, gender pay, modern slavery, that have been around for a number of years, but it's going to be something that's going to continue. Probably expect it to be ramping up and getting broader in terms of, what companies and businesses are needing to do. I guess a recent example really is TCFD, which is the Task Force on Climate-Related Financial Disclosures. So this was originally a voluntary disclosure requirement established back in 2015. But in 2020, the UK government announced that they would be mandating it on a phased approach through to 2025. So there will have been businesses that were choosing to adopt this historically, but now it's very much requiring that to be very much the norm. It's taking it further than just understanding what is a business's impact on the environment, and it's looking at what is the impact of climate change on a business. So there's been a lot of attention to date on how do we reduce our carbon emissions. But I guess even if your business does achieve net zero, climate change is still happening unless everyone, does their part. There is still going to be an impact. So it's about how does the impact of climate change, the risks and opportunities that there is, how do they impact your business? How are you going to be responding to those in the short, the medium, and the longer term? It's very much a disclosure-based requirement, so something that will be within annual reporting alongside financial reporting, but it isn't as specific as other reporting requirements, where it's understand what the risks and opportunities are to your business and then report on those, identify metrics that demonstrate how you are managing and exploiting those risks and opportunities. So for example, there'll be physical risks that will impact businesses. So for example, with retail, products will come from kind of raw materials. We're seeing, for example, particular materials can become more scarce. So in the shorter term, you might be looking at how you're diversifying your supply chain, but in the medium longer term, it can evolve into an opportunity. So how are you innovating your product range to kind of place yourself in a better position? There's also then the transition element. So the transition to the lower carbon economy, like Tom mentioned. So how are you putting yourself in a position that in the future, as we're seeing kind of the trend for lower carbon, greener products increasing, how are you going to be best placed to kind of respond to that? But it's linking it very much back to the financial aspect, your business, not just from a sort of greener aspect.
Thanks, Zoe. And picking up one of the points that you raised there, and it is going to be the theme that we move on to after this session, just around the challenges in the global supply chain that we specifically saw through that COVID period. But for our sector, we're continuing to see them as we go through 2022. With those challenges, with that supply chain suffering slightly, Tom, do you think that this ESG landscape should spark a change, maybe helps in some of those challenges that businesses are seeing?
I think we have seen an element of change. I think we can't underestimate how many things different businesses have been trying to juggle in the last 18 months. And typically a supply chain review or an overhaul is quite a comprehensive initiative for a business to undertake. But I think there are certainly, as Zoe indicated, some raw materials and resources which are now being either being reduced in terms of the volumes that you can get hold of, or becoming cost prohibitive to bring from whatever destination you were bringing them from originally, that are making people have to really consider what ingredients or garment types they are selling. And so I think we are going to start to see more a shift. Certainly, a lot of products coming from Asia, and everyone's probably seen the imagery of the kind of Shanghai waters and how crowded they all are with nothing moving anywhere. People are going to need to validate other sources for supply. I also think within the supply chain infrastructure, people are going to consider how can they actually reduce their footprint as it relates to electric vehicles. And we saw the big announcements with Amazon really moving the agenda there. I also think the kind of consumption and space utilization as it relates to warehousing and the energy drain that would have is an area of focus. And we've seen some really interesting initiatives about zero footprint warehousing space, energy efficient warehousing space, all really trying to not only control costs because they can be cost beneficial, but also to really start to think about their impact as a supply chain on both the environment and the economy.
And as we talk about the ESG agenda, I think it would be wrong for us to stand here and think that people haven't got a very long to-do list right now, and particularly in the short term. Do we think this is something that people will move to one side so that they can look to overcome some of the shorter term challenges? And if they do that, is that going to be a bigger challenge for them as they move forward? Tom, I'll start with you, and then maybe Zoe, we can get your thoughts as well.
Yeah, I mentioned that there are a lot of things that businesses are trying to achieve at the moment, and some of the kind of headwinds that we're facing are, top priority. But I think we've also got to understand the kind of wave of consumer sentiment that's coming through, the kind of power and the spend that will sit with the younger generations, the millennials. Ethical products or ethical sourcing is now featuring in a lot of top 3, what we say KPCs, are key purchase criteria. So it has to be evident that retailers, businesses, brands have either ethical products, ethical sourcing, or are really truly believing some of this is coming through. So I think the ones that are trying to cover up possibly infrastructure or supply chains that are working but not necessarily as sound or as ethical are going to be found out by the consumers. So I think there is going to be a drive driven probably by the consumers to ask more from those retailers and brands. The second bit that I do think we are going to have, we will see more visibly is the kind of authentic stories you are seeing from brands and how they use that to engage customers. So you can already hear and see certain brands with much more clear purpose who have gained significant traction because the ability with the right narrative and the right story to engage across social media, across other marketing channels is vast. And you can point to the kind of global brands like Patagonia, or you can see more smaller brands that are really already, whilst revenues might not be so significant, audience following is huge. And I think that's going to be quite a trend coming forward, to seeing these small brands become quite large quite quickly.
Zoe, anything to add?
I think it's all about just really, I think the first point I made about understanding what it means in the context of your business. And there will be different elements that have more of an impact in the short, the medium, and the longer term. And it's really important just to have it in mind. So when you are going through key decisions or looking at kind of strategies, having these elements in mind, thinking about what the impact is it something that you need to be considering now, particularly some of the environmental pieces or the social pieces, or is it something that will become kind of more important kind of in the next few years? I think one of the things can often think is like, so for example, net zero 2050 target sounds a very long way away. It will come round very quickly, so it's having it in your mind so that you don't kind of not react until it is too late.
Perfect. Well, thank you both. Hopefully for our audience today, there's a bit of food for thought in some of the discussion we've had around the ESG agenda. And as we talked about, and we talked about in that session, I think we need to move on to how do we face some of the challenges of costs. So with that, I'll pass over to Neil, and we'll continue the next debate.
Thank you, Laura. So Laura is going to move from question master to panelists now, and I'm going to be joined by Sarah Raymond and Laurie Hannant. And we're going to spend a bit of time thinking about stock portfolios, and in particular the valuation of stock portfolios in the current inflationary environment. So Laurie, I'll kick off with you if I may. With inflation at its 30-year peak, energy prices at an all-time high and still rising, and container prices significantly above where they were at pre-COVID levels, how are you seeing these issues translate into retailers valuing their stock portfolios?
Thanks, Neil. Yeah, so if we go to the basic principle that stock is valued at the lower of cost and net realisable value, cost essentially is that purchase price plus freight and duty. And with duty increases post-Brexit, you could also be impacted by those high freight prices, particularly in that peak over the summer, if you've still got that stock to sell through as well on your balance sheet.
Yeah. And many of our retailers have sort of bought ahead of the curve, given all the challenges that they've been facing over the last few years. How does that feed through into valuation issues?
Yeah, so it comes back again to that basic principle and the net realisable value piece around, have you got too much stock? And therefore, are you going to need to discount it heavily against that inflated price to be able to sell it through, and also to attract consumer spend as well. So it's really taken into account and reviewing your year-end inventory valuation carefully to check, firstly, have you got overvalued stock that you're going to have to sell at a lower value? And secondly, have you got excess stock? And I have heard of businesses that have taken extra warehouses to deal with the supply chain issues, really, and that could cause overstocking if that hasn't been sold through.
Yeah. And Laura, turning to you, what are you seeing from a transaction perspective in this area?
It's interesting. It's definitely making life interesting and our discussions interesting. So the one thing that is interesting when we look at the cost of shipping is that we've already started to see that move away from the peak that we saw in the summer of last year. Yeah. And what we're doing is we're carefully tracking that. We have quarterly updates that we're issuing to the market, and what we're doing this quarter is actually going to our clients, to businesses in the sector, and getting real tangible data as to what are people actually paying, both in forward buying and spot rate containers at the moment. But it is moving, it has moved quite considerably. And so what we're having to do is work very hard to make sure that we can position the business on what are the actual margins that people are going to be achieving in businesses in the longer term. Because for 2022, the number of discussions that I'm having with clients are that revenue probably will grow 2022, but the actual underlying profitability of the business will be significantly lower because of just every cost impact that is coming onto the essentially the books of businesses. But stock being one of those big issues, as Laurie said, where if you really, really don't understand what that cost of product is, then the margins are going to be even lower than you're expecting, which when we get into the latter stages of this year and start looking at working capital and reinvestment back into the stock cycle, people are going to be short on cash, which means that they're just going to be able to, they're probably going to have a period to which their growth could then become flatter, as they don't have the level of investment they'd like to make, just because of this year being probably one of the most expensive years in the sector that we've seen for some time.
Yeah, lovely. And in terms of picking up that point on having cash tied up in stock, Sarah, do you want to comment on what that means from a asset-backed lending perspective?
Yeah, sure. So one of the alternatives to just using your cash is obviously to have an asset-based lending inventory financing, but they will those financiers will look at stock in a different way from the valuation necessarily on the balance sheet. They will look at what are you actually likely to, what is that stock going to realise? So yes, of course they take into account, the appraisal will take into account what is sat on in the balance sheet, but they will look at the realisable value. So what facilities are available to a business will be dependent on what they have calculated looking at the liquidated valuation of that stock. So if a business, and we have heard of businesses where they have they've taken a stock finance facility and the borrower has then materially increased material costs for the reason for doing so, and that then gave them a much bigger headroom because they had a higher valuation of stock available to them. And the lender then said, well, no, that doesn't quite work, because actually let's look at what do we think the realisable value of that stock is going to be, and actually then significantly reduced the headroom that was available. So in terms of the facilities that are available, it's just realising that retailers have to be close to the actual valuation and what is going to be achieved in terms of getting those facilities from the asset-based lenders, and the lending community is obviously really hot on this currently.
Yeah, and following that theme through, Sarah, linked to lending, a lot of our retail clients will have covenant reporting requirements. So how do these issues play out in that scenario?
It just comes back to, if you're not on top of your stock valuation and you're reporting and making sure you've got the right value in your accounts, that will result in possibly volatile information in the management accounts. When those management accounts are then used for covenant reporting purposes, and so that it can give a misstated position to the lenders. So it's key that both businesses and lenders understand what is actually going on within the business, and that the business is reporting, so the lenders don't want to have nasty surprises stored up when there's an adjustment on the balance sheet. So it's really key that businesses are on top of the real valuation, which goes back to where Laura and Laurie were talking before about adjusting as to what is the true picture.
Yeah, super. And then finally, based on your experience and discussions with clients, and Laurie, I'll come to you first for this. What sort of top tips would you leave the audience for managing stock in this current climate?
From my perspective, it would be, don't leave it till the year end to check that your stock valuation accurately takes into account the freight and duty at the point of purchase, and also that you are doing an adequate provision review, not just on a net realizable value basis, but also whether you do have any excess stock.
And Laura?
I think for retailers, cash is king in a lot of ways, and I think there could be some real hesitancy this year of clearing down stock when we take Sophie's earlier session on, are we going to see a slight decline in the ability for the consumer to continue to spend at the pace that they perhaps have, and just sitting on stock because it is technically more expensive than you'd like it to be is only going to give you quite a big headache as you move forward. I think the key for me is to therefore make sure that you really understand the underlying cost. And so then when you are going into the market, perhaps looking to do sell through, that you know why you're putting the discounts on, but also what that means and what that ultimate underlying cash balance is going to be when you come back to want to put that back into new stock, and stock that actually is going to be at a lower value. And for retailers and consumer brands that get this right, what we are going to see is the ability to increase costs. So, prices of products will increase this year, will have to mitigate some of this. But some of these costs will come down again. So actually, if you get this right, the business underlying all of this cost of product will mean that long-term profitability should increase for businesses, but it's going to take some work, and it definitely is about the detail.
Yeah, great. And Sarah, any final thoughts from you?
It really follows on from what Laura's just said. We would say robust forecasting that could be sensitized, so you understand exactly what's going on with your business, understand how your capital is being tied up, working capital is being tied up, looking at seeing how you can minimize costs, hold costs, and whether there's areas of the business that you can release costs from, and that goes back to one of the points that Tom mentioned, which was looking at the supply chain, you know, a full procurement review. Tom was looking at it from an ESG perspective. We would be looking at it from a cost perspective and whether or not there's some sort of cost savings that can be generated from that. So it's really just being vigilant with your businesses over the coming months, which are going to be hard, as we all just said.
Thank you all. We'll pause there, and lots of food for thought, and it continues to be a very challenging topic. So I think with that, I'm going to hand back to Laura, and she is going to resume her compare role.
Thanks, Neil. And actually, we're now at a part of our session today where we're going to hopefully get some questions from our people behind the scenes who have joined us today. So if you do have any questions, do feel free to post them in the question and answer box that is you should all have access to. Equally, I'm going to ask all of my fellow colleagues to come back, and if Zoe and Tom can join us, it'll allow us to perhaps be able to answer some of the questions that the audience are going to pose. To kick off, I think one of the things that I have regular conversations with clients about is the unpredictable landscape that we face over the next 12 months in terms of customer spending. Going to you first, Sophie, on the back of the High Street Sales Tracker, yeah, how can retailers, how far do you think retailers can really stretch pricing as we go forward? Do you think that's going to affect what we see in things like the High Street Sales Tracker? Are there any words of advice that you would give from your conversations that you're having with a number of our clients also that might help that?
It's really difficult because when the consumer purse is squeezed in the way that we all know it's been squeezed, it's discretionary spend which is going to be hit because essential spend has to carry on. I think, however, it's really about understanding your customer and the product and the pricing that works for that customer, because we're also seeing there's quite a difference emerging between demographics as well. And there is still savings from the A and B categories compared to the low categories. So we are going to, I believe, again, see this shift of people shifting down in terms of that pricing point. So I think in terms of retailers increasing their pricing, it's going to be inevitable. They have to. They can only absorb the cost so far, and they're going to increase it, but they're going to have to get smarter with their pricing as well. So it's really understanding their customer, understanding the product on which they can increase that price, and making sure that they've got the right product for their specific customer. But as I say, I think they can only absorb so much.
And I think that's very fair. And Tom, going to you, who is clearly someone that is working with a number of businesses over the short-term, medium, long-term strategy, your lens into what Sophie's just been discussing?
Yeah, so it will vary by sector. If I take apparel, I do think we're going to see people, invest more in price. So if you just took the typical good, better, best architecture, there's going to be more emphasis on leaner entry price points. The backdrop to that, I think, is going to be the struggle to hit certain price points which attract the customer, given that actually some of the ways people are curating products is around more ethical, more organic cottons and aspects that are probably actually at a more premium basis. So in apparel, I do think that ranges might be the way that people can flex price. I think in more fast-paced consumer goods, we're going to see promotional activity ramp up again. In the grocery aisles, you're going to see private label feature more, and we saw that in the pandemic. In certain categories, people went to value. In others, they actually went to brands. So, you know, we saw a lot of people with detergents and soaps and everything really push for brands. And where there is that brand loyalty, then there is that stretch that people can have on price. So I think different sectors are going to behave slightly differently. I would pick up one point, which is people will have the essentials that Sophie mentioned, and people will have those elements of discretionary spend. In the macro perspective that we have in this, certainly next 3-4 months, there could be big ticket items like travel being postponed, which could actually allow for a period where there is more disposable spend to attract. Coming into the kind of Q3, Q4, I think we'll probably see the real impact. And that is where I think if you've got a voice and a community, you can benefit from having your brand top of mind for people when they come to those purchases.
And that probably takes us very nicely in some ways to a question from Joel. So I'll stick with you, Tom, for this one to start. What are the core drivers for acquisitions in retail this year? And what do you think has changed from 2 years ago? If we stand in 2019 and what was driving people to acquire businesses or not acquire businesses, what are those big things that have changed?
I think there's a whole manner of different things are going to happen. There's going to be businesses that require recapitalization. They may have needed funding during the pandemic to cover what obviously was increased business costs as it related to being more being able to survive when shops were shut and it was difficult to trade. So I think there's a lot of debt that's come into businesses where they may be looking to recapitalize, and they've dealt with all of the historic challenges and are now set up for possibly a little bit more growth. There will naturally be some buy and build opportunities, not necessarily buy and build, but people that some of the bigger apparel groups will look at some of these smaller players, and that will be to bolt on both capability, either an e-commerce platform or something that is interesting, or a niche in the market that they don't own. And I re-reference that higher street and M&S. People are going to look for different ways that they can furnish themselves, and it might be with technology, but it's probably also likely to be with some brands. That's one area of kind of M&A. I also think that there are a number of small brands that have popped up in the last 2 to 3 years that have got scale through the huge digital surge that we've witnessed in the last 2 years. So the communities that people have been able to develop when everyone's been shopping online are quite vast. And now you open up for those brands the ability to pick channels at which they go to market, things that they haven't done yet if they've been pure e-commerce players. Physical retail still has a role, and some sites and locations in the UK are going to become viable and attractive given the rents that new people can come into. Those with already leveraged estates are going to have to kind of rationalize. So I think that will spike an element of acquisition. And the last one I point to is, the UK has always been great at getting brands across all sectors that are very exportable. And we're seeing brands that have started to really resonate in the US. That could be anything from apparel, footwear to even consumer goods. And that international lever for a business or a brand, it really attracts certainly private equity money. So I think there's quite a few within that, and I think there could be some interesting M&A in the next 12 months.
And I think staying on the I suppose the positive M&A just for a moment, because you're right, Tom, brand DNA has always been something that we talk to people about when we talk about how do you maximize value, how do you make it interesting. And I think what has perhaps changed over the last couple of years is what makes brands unique. And we're seeing just ahead of COVID, how do you stand, real challenges on how you stand out to the consumer and what makes brands different, what makes them resonate. And Laurie, I don't know whether you've got any thoughts on, as Tom was alluding to, some of these newer routes to the consumer, the circular economy, just a different way of doing things in retail. what's your thoughts about whether that's going to be the retail landscape of the future?
Yeah, thanks, Laura. It's a difficult one, isn't it? So, I mean, I see my clients in particular, I've seen some of them move from online to looking, as Tom said, to where can we now have a bricks and mortar presence, and where's the best place to do that, and what's our store going to look like? You've also seen, obviously, the trend with department stores repurposing themselves in a destination rather than just a store. And that has had some benefit to them. But again, I think it really is about social media presence as well. So I have a client that's quite a traditional apparel business, and they've had to really push their social media presence and really change the way that they would normally do things to attract that type of customer, particularly during COVID. So I suppose my message would be just be brave and try something new, try something different, because the consumer landscape and consumer behaviours are changing regularly.
And Sophie, you work with some of the UK's largest retailers. Do you think that acquisition is going to be on their agenda this year?
I think acquisitions are going to be on, will always be on an agenda. It depends. The purpose behind acquisitions is always different, isn't it? So whether it's acquiring something which helps you streamline something more in your business, or is a nice synergy fit, or I certainly think it will be, and there's some very attractive businesses in different aspects which you can bring into your business. So yes, and likewise disposals of different parts of businesses as well. So it's the two really.
And Sarah, people are going to be thinking, we've had some incredible success stories over the last couple of years of growth. There's been others that have found it more challenging, and as Tom said, there's potentially a bit of a build-up of debt out there. So are there going to be interesting opportunities to buy more distressed businesses? Do you think that the market is going to be fairly buoyant in the sector on businesses that do look to consolidate, those that perhaps can't weather yet another storm?
Yeah, I think over the last couple of years we've not seen the volume of distressed retailers that we had anticipated, and that's been, as we all know, from the volume of government support that's been made available. I think the headwinds that the businesses are now facing will create situations where businesses do need to look to restructure. Larger groups may look to divest of certain divisions that maybe aren't performing as well, and there will be corporate failures. So I do think there will be opportunities out there for those that are looking to build portfolios of brands, and also to bolt on maybe different areas of the sector that they weren't necessarily in before. So I think we will see some interesting situations over the next, probably for a couple of months towards the last quarter of this year, but I think there will start to be a flow of restructurings and opportunities.
And Neil, Tom touched on that one of the things that is interesting for people is global reach of brands. So the UK is an incredible environment to grow consumer brands, and we've seen real success stories. But where we're seeing the big valuations is when they have international reach. A couple of hints and tips that we both know people could benefit from hearing from you, just around, if you're going to do that, getting your house in order. Do you want to just give a few hints to the audience?
Yeah, absolutely. So in terms of your domestic house, I think the two bits I would have on your agenda are, Sarah referenced all the government support that's been provided over the last couple of years. The revenue are looking into those claims for support quite vociferously. So make sure you've got your house in order and you can justify the claims that were made, and deal with any revenue inquiries on the front foot rather than being asked. The second thing is, despite all the challenges, there's still quite a lot of investment activity going on. So really look at the tax position for the cost that you're investing and make sure you're maximising any tax relief that you can claim. And then specifically on the sort of international expansion point, I think if you're going to do it right, you've got to do it properly, which means talking early to people like me to make sure that you understand the tax landscape in the territory that you're moving into. We've seen a lot of retailers struggling with the challenges of trading in a post-Brexit world and getting VAT registrations where they need them, and dealing with the complex duty position and proof of origin stuff. And, you know, when you're going into, maybe it's the Far East or the US, the challenges are the same, if not sometimes more difficult, particularly where there is a language barrier to get across. So really think carefully about the decisions you're making, talk early to people on the ground so that you understand what you're getting into and what you need to be doing, because the last thing that you want to end up with is an inquiry from an overseas tax authority, which takes an inordinate amount of time to deal with. If you can get it right in the first place, that is the best way forward.
And Neil, sticking with you for a second, your view of whether Brexit still affects this sector, or do we think it's moving to an opportunity? Has it settled down, or do we still see those challenges?
Unfortunately, we still see those challenges. In some respects, businesses have found a route through to deal with, I would say, the minimum compliance requirements, and that has been a challenge in itself. I don't think the taps have been fully turned back on in terms of European expansion and such like. And the principal reason for that is the volume of compliance businesses have to deal with in that regard and get to the bottom of. And it's a massive challenge on top of the day-to-day stuff we've been talking about today that they're having to deal with. So there's definitely still challenges there. It's not settled to a happy medium, but with those challenges, if you can overcome them, there is definite opportunities for growth.
Laurie, any further thoughts from our audit perspective on what clients are seeing and whether they're seeing it settle down?
Yeah, I'm still seeing with my clients that it is still a challenge really to get that paperwork together, to get the goods in on a timely basis. Also double tariffs as well, where you're bringing in from the EU and also selling back out to the EU. So yes, it is still challenging. I think it's going to take a while for that to settle down properly.
And so as we bring today's session to a close, as my colleagues know, I always like to put them on the spot and leave our audience with a little bit more food for thought. So starting from my screen at the top, Sarah, just one thing that you think is a takeaway that people could perhaps think about as they grab a cup of coffee or a bit of lunch following this session?
Takeaway, well, I'm business restructuring, so I would say plan. Make sure that you've got a good solid business plan and forecasting, and do a sort of drains up on your business and identify where you can save costs.
Neil?
Laura, I would say don't forget about tax. in the current environment with so many different things and the volume of things on to-do lists, those tax issues you've been meaning to deal with often move down the list. They become a priority, a bit like the conversation we had around ESG. If you leave them too long, they will become overwhelming. So keep it on your agenda.
Sophie?
I agree with Sarah, plan, but make sure your plans remain flexible and that you can change direction, because the headwinds, we don't know all what they all look like yet, but we know that they're out there.
Laurie?
I would just say, just to check and circle back that your inventory valuation includes the right freight and duty prices.
Zoe?
I would say maybe just keep an eye on what's happening in the ESG agenda. There's a lot of regulation coming, new standards being launched for discussion all the time. So just keep an eye on what's coming further down the line so that you're in the best position to respond when you can.
And because I know he'll end on a positive note, so I've left Tom till last. So something that they can take away as a positive, Tom.
I would say the positive is that through the digital means, you can access the customer sentiment more accurately and more real time than ever before. So do it. Listen out, listen to what they're saying, take pointers, and make sure what you're reacting to is in as authentic manner as possible.
Well, thank you all to my fellow colleagues for today. Thank you everyone in the audience for joining us. We've popped up there the date of our next webinar, and we'd be delighted if you join us again, where again we'll be thinking about what are those real issues facing each and every one of you. We've got a feedback form where we're asking the question as to what do you want us to debate on these, so we'd love to hear from you all. Equally, for those that are less aware of our high street sales tracker that Sophie touched on, we popped some contact details down there. Do feel free to message Jenny, who can give you a bit more information, because we'd love more and more people to contribute to that. So on that note, we are going to wish you a very good weekend, a very good rest of the day, and thank you for joining us.